42% inflation, biggest worry. How about you, Jenny?
So that's actually not my biggest worry anymore. It was 2.5 months ago, but to your point about talking until we don't have teeth left and we only have gums, we have talked about inflation. We have digested, dissected, debated, speculated every version of what inflation might be. Is it temporary? Is it sustained? Blah, 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 blah. So the reality is I don't think this is going to be the biggest risk anymore because we've talked about it too much. And once you talk about something too much, it becomes incorporated into the overall market. I think we're anticipating many different potential scenarios. I actually don't think that's it. I think it goes back to Steve's point. I don't think any of those four are actually it. Whatever does bite us in the, you know what? We're not anticipating it. We have no idea what it's going to be. It's always something that you don't expect.
So your biggest risk to the market is something you can't anticipate, do not know, basically.
Always.
Fair point. Fair point. I'm going to wrap this part up and move on to the next question in just a minute. Josh, let me get your thought on that. What do you think the biggest risk to the market in the second half will be?
Well, I think Jenny's right. It's always an exogenous event. Like, even if you just go back 2 years, look at all the chief strategist notes from the fourth quarter of 2019 doing their 2020 preview. It's not that they're doing shoddy work or that they're not intelligent, but they're all repeating a version of the same thing together, saying like, all right, this is what we're concerned with for 2020. And of course, top of everyone's list was election, right? You can only imagine. And then 2 months later, we have the worst pandemic in a century. Millions of people die, literally. Nobody had that in their note. So I hate to say this. There's going to be a reason to panic at some point in the future. There always is. Sometimes that'll be a valid reason. Most of the time it won't be. We have to, if we say we want to earn above risk-free rates of return, right now risk-free rate of return is below the rate of inflation. It's basically zero. But if we say we want better than that, it's not free. The trade-off is we have to deal with what Jenny is talking about, which is some curveball coming out of nowhere and forcing us to confront a whole new risk that many people weren't considering. And that will happen. I'm 44 years old. I'm going to watch 1,000 versions of that happen throughout my investing career. I have made peace with that. The audience listening to us today has to make peace with that. But Tyler, the big picture, if they've been watching our show for the last 3, 5, 7, 10 years, is that the sun's going to come out tomorrow. And you may not like the next bit of news that hits, but we have to invest as though there will be a tomorrow. And Jenny and Steve and Jim Lebenthal and the rest of us, that's what I think we try to bring to the table each day, that idea. And by the way, that idea has enabled people to earn 15% annualized returns in the S&P 500 over the last 10 years. Not bad for a, quote, low return environment.